Hi everyone, Natu Myers here again, back with another video. And in this video, I'm going to tell you how you can use urgency to get your investors in quicker. So, one of the Raises.com members, he was an ex-Wells Fargo person, and he was working on, creating a private placement. And so, when we looked at what he was working on and we saw some of the goals that he had, I mean, he was doing a $100 million raise in total within the next 2 years. But he understood that, even though him and his team were investing, he needed to make sure that he would get a lot of urgency for people to come in, especially because the interest rates are going, at the time of this recording, the interest rates are pretty low and they're about to increase like crazy. So the ways that we consult and help people, set up a structure that makes sense for getting investors to move quickly. The main way, number one, is really just making sure that things appear to be limited. So even in something where there are unlimited shares to be offered, there's an unlimited offering, because every company can really, from as far as our knowledge goes, whenever there's a company incorporated, there are a limited amount of shares created. And if somebody is doing like an unlimited offering and they want to raise capital forever for them to invest in almost like an infinite amount of things, the thing is, like, when a company is incorporated, there's a limited amount of shares. So the way to do it is just to commence and start with one offering, kind of like part of the reason why some people may even call it Series A, Series B, and so on. There's one offering where there's an X amount of shares, and these shares, there is a future promise of potentially the company coming back and doing another offering by splitting more shares or creating more shares, but there's always a limit to the shares, or dividing shares, or whatever. But the point is to make sure that things are limited, because the more limited things are, the more value you can create. So this is just the plain and simple number one. Number two is making sure that, as time passes and people choose to invest in the transaction, that you look at the incentives that are in place. Because if somebody invests, the people that come in earlier, because some people want large check investors, and then so if you want a large check investor, you'll make it beneficial for the first, let's say $10 million raised to be offered at a cheaper share price than if you want to raise after the next 5 million, for example, raise, and so on. Or you can motivate people to stay in a fund, for example, if it's a fund and it's not like a one-off transaction. You can lower the management fees, or you can lower any broker points or any fees that are associated with managing the fees on behalf of an investor based on how much they invest, if the investment amount is what you're prioritizing for. So some people prioritize for the investment amounts. Other people prioritize for just getting somebody in quick. And so it'll be more about the first person that invests would have either a discount or they would have a reduced fee, when it comes to management fees, if you're talking about a fund structure. So rather than calling it a fee reduction, one way we push clients in the direction of more of talking about discounts introduction. Because saying something is at discounted rates is typically better than saying that it's something that is, that the fee is reduced. For example, if you just talking about psychology from, Kahneman and some of the top people in behavioral economics, what they always say is that, for example, you look at some beef. If you say some beef is 90% lean, it sounds so much better than beef that is 10% fat. That's why we say things like, you get people to say things on their private placement memorandums, 90% discount versus 10% fee. So the same thing applies, and use that language really carefully. And the final thing is when you talk about future benefits, for example, listing on exchange. You can look at, when people list on exchange, you can look at different incentives and even more discounts that you can apply as well. And finally, understand that there are different ways to play with the share structure. Because if somebody's listing a company and then they have, instead of just making everything all common shares, you can look at the discount that the team is investing. So if the team is investing into, for example, a REIT or a real estate fund and so on, you can look at okay, our team is going to have preferred A shares, and they're going to be valued at a cheaper price. And everyone that invests alongside us get that benefit. And then afterwards, you can have pref B shares, where there's a different amount and a different voting rights and a different price that is a bit higher. So this is really pretty much an extension on the point on discounting fees, but this is more on in emphasizing the company structure. And you can have your capitalization table, the amount of shares that people have in a company, by looking at what the teammates are investing in, if anything, and looking at different ways to structure the share structure based on your plans to go public, the plans to distribute dividends, the plans to withhold and share different shares for other people, and then your own future plans to to divide shares in the future and make other offerings. All these things should be kept in mind before you even raise capital. And so that's why it's really important, and a lot of the members at Raises.com agree that for an offering, whether you're raising capital with a syndication to acquire a deal, an apartment complex or whatever, or you're creating like an open-ended fund, you're creating a closed-ended fund or a REIT, it's really important to understand what are the incentives that you want to have in place. And if the incentive is urgency, then it's all about limiting things, creating scarcity, and it's about adding discounts based on the share structure in the entire deal. The final thing I'm going to say is look at getting soft commitments. And a lot of people will offer you soft commitments, and they would even send you letters saying that they'll do due diligence, we're going to fund the deal. And one of our members got, they got 9 figures in soft commitments. And obviously a soft commitment doesn't really mean anything, but it's better than nothing. So you can use a soft commitment to get people interested and show like your deal has proof of concept in terms of interest, to increase that scarcity and that urgency so that people are more incentivized to jump in. And this is what our team told one client to do, is to leverage his, the soft commitments he had, so that when he went to other investors, he was able to say that, oh, we have a lot of interest, this thing may be going quick, because nobody likes to be the first one in. But if you want to get the first one in, you have to look to get soft commitments. And getting soft commitments also reduces a lot of risk, because instead of you paying a lawyer $300K, $200K, $100K to build your entire deal for you, sometimes it's best just to find a compliance way to see if the market is interested in what you're offering in the first place, so that you have something that could be raised for to begin with. And so with all these things, I hope this makes a bit of sense. So mainly, if somebody's looking to get people urgently, jumping on your deal pretty quickly, or no matter what you're incentivizing an investor to do when it comes to investing, whether you want large check investors or quick investors, apply discounts based on the time of investment and the deal size. Look at structuring the entire share structure and the capitalization structure based on the discounts that you want, right? From beginning up to listing, based on if your company is open-ended fund, closed-end fund, REITs, or something in the middle. And then look at soliciting soft commitments in places where it's compliant to do so that you can stack these up against one another so that investors can compete for each other's time. And when you stack all these things on top of each other, then you're going to have a really powerful offering that will get funded in far less time. And obviously keep things limited whenever there's a point to, because the more limited things are, the more incentive there is to act. And so with all these things, I trust that this is going to get you well on your way. Well, what is Raises.com? What do we do? Well, unlike my caller that is a bit unbalanced, we bring some balance to your capital raise by, again, doing things like this, like the things that we discussed in preparation, and also the execution of the capital raise in the most quick and compliant way. If there's something that piques your interest, just head to Raises.com. Otherwise, hit the subscribe button, click the bell for notifications, and click the like if this is something that you want more of. Because this is something that people pay a lot of money to get access to, this knowledge. So we'll see you in the next video.